Thank you, everybody, for joining Transformational Tuesday. Today, we're going to be talking about how passive investors get paid without managing properties. So again, this is an educational series. All real estate investing does have its own risks, and you should be doing your own. Oh, hold on, I don't think I'm sharing my screen. I'm so sorry. That would help if I share my screen. Let's start over. Hi, so this is Trevor with Massive Capital, and today we're going to be talking about real estate syndications, and we're going to talk about how passive investors get paid without doing any of the work. And so this is an educational series. We do try to present what we believe to be true and accurate, but you must always do your own due diligence before any real estate investing. So about myself, I started investing in 2018. I have been a passive investor, limited partner in 20 syndications, and then I've been a general partner sponsor in 16 for a total of 36. One of the things that I found was I didn't find this out. I was always interested in real estate, terrified of toilets, tenants, and trash, and I thought I had to be a millionaire to participate in commercial real estate. And then I found out about this amazing thing called syndications, and I went, wow, where is this? And I created a mission to be able to tell others about it. A little bit about Massive Capital. We're a vertically integrated real estate company. We're a developer Class A retail and town centers. We're also owner operator of value add multifamily. We are very Texas focused, although we do have some assets in Georgia, North Carolina, and Denver, Colorado. We are partnered with Realty One on the new development side, and they have about 300 million in assets. And then Massive Capital has about 200 million in assets under management at this time.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
So today we're going to talk about syndications. How do you make money? We're going to talk about understanding the returns, why I believe multifamily is still a good investment, and then the top 10 reasons to invest in 2026. And then, of course, any time for Q&A. So again, let's talk a little bit about syndications. Syndication is a group of investors who pool money to buy or develop real estate. Syndications are ways for investors to invest in larger properties that they couldn't afford on their own. So for example, I'm a passive investor in 300 A-class properties. They're like $30 million properties. Never in my wildest dream did I think I could own a portion of that. And how does it work? You have sponsors, general partners. So if you remember before, I mentioned I was on 16 of those. They're experienced real estate professionals who organize the syndication, secure the funding, and then implement the business plan. And then we use other people's money. You hear a lot about that in real estate. Those are our passive investors, often called LPs. They're the ones who fund the project and they own a portion of the asset. So here's the real beautiful thing. We all know, if you read Rich Dad, Poor Dad, we all know about the power of leverage buying real estate. Leverage is what makes real estate work. And then, of course, using the passive investor money is another way for us to be able to grow and to get to the next level. But let me explain it even a little more clearly. Let's say we're going to buy a $10 million property, and this is a very simplistic overview. It's a $10 million property. The partners are going to secure a $7 million loan. So they secure the loan, and you normally get it about a 70% loan to value. And so we're going to raise $3 million from our limited partners. And we would actually need to raise a little bit more because there's other costs involved. But I'm trying to keep it simplistic for my example. And the beautiful thing is, right, we're using leverage to buy the property. And then the passive investors put up about 30% of the capital. But here is the magic. They will own 70% of that actual real hard asset. They actually own a portion of it. And as a limited partner, it protects your personal assets. So if you're on the single family side, you're at great risk if something terrible happens. On this particular side, you are protected. The general partners take all of the risk and all of the liability. So yes, you could lose your investment. I want to make sure I'm honest, but that's all. You would have no other catastrophes that would happen. And then again, you can target investments and on specific projects. You don't have to be an expert in everything. So later on, we'll be telling you about an assisted living we're closing on next week. We have some multifamily properties, and all of these we have experienced partners. And again, the returns are tied directly to the success of the property. And even better, the returns are tied to a mutual success. So we as general partners don't get paid until our passive investors get paid first, and no other company's doing that. Microsoft is saying, well, executives, if we don't pay the investors anything, we're going to not worry about it. No, they're going to make their money no matter what they do. So there are two ways we can do on our securities. Number one is a 506B. And a 506B, we must have a previous existing relationship, and you must be considered a sophisticated investor. And our training helps with this. Several are part of other groups where you get trained, and you need to verify that you're a sophisticated investor. Now, does that mean you know everything? No, it does not. It just means that you know enough to understand the risk. And on these investments, there are only 35 spots for non-accredited investors. And so Massive Capital always gives first access to these deals to our community. So we make sure, so we have a big database of like 8,000 people, but 3,000 people we have a one-on-one relationship with. They're the only ones that get sent the opportunity in advance so they can do it. And I cannot generally solicit. So I have to make sure I know you before I talk about a deal. So I can't talk about a 506B deal on these webinars because they get posted publicly and I can't control who's going to see everything. And then we will switch our investments over to a 506B. Oh, I should have mentioned on a 506B, an accredited investor can invest. And in fact, I recommend they do because you can self-select that you're accredited and you don't have to verify it. But when we switch it to a 506C, only accredited investors can invest. You have to have $1 million in assets excluding your home. So these would be all your personal property, all your savings. It can be retirement accounts. There's lots of things that would go into here. Or an individual income of 200 and a family income of 300. And then for me as the sponsor, there is no restrictions on soliciting. It gives me the biggest ability to market to everybody. And please know there is no difference between a 506B or a C. They are the same deal. It only limits who can invest and can I market. So again, if you are interested in, hold on, sorry, not too fast here. If you're interested in being sure that you're on our 506B, we have to establish this relationship. So book a call with me, and then we'll talk about what are your real estate investing goals, where are you financially, make sure that you are a sophisticated investor, and just book a call with me and say, please give me that sneak peek at your next deal. So this is one of the things that's one of my favorite statements by the great Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. And it's amazing. You know, I knew this as a child, right? I played Monopoly and I loved playing Monopoly. And I knew the people that bought the houses and turned them into hotels actually won the game. And it was just amazing how they did it. Then I became an adult and I just went around the board and I was a player. I was not buying the real estate. So again, another power of real estate investing, in fact, this goes for any investing, is the power of compounding your money. So our goal is to double your money every 5 years. And I don't take any taxes into an account here. So this is a very simplistic view of it, because yes, you will have to pay taxes unless you were really smart and you invested with a Roth IRA, then it grows tax-free. If you're investing with a traditional IRA, it's tax deferred. And of course, if you're investing with cash, you will have to pay taxes at some point on it. So again, you take 100,000 and you grow it to 2. And then you take that 200, grow it to 4. Take that 4, grow it to 8. Take that 8, grow it to 1.6 million, 1.6 million to 3.2 million. Who here, starting with just $100,000, thinks that being able to grow it to $3.2 million is pretty amazing, right? So again, even if you're paying taxes, even if you're doing things, this is the power of leaving your money invested. So again, we do all of our deals through Massive Masters. And if you hang out with successful people, they will brainwash you into believing in yourself and thinking that you can achieve anything. So we're going to talk a little bit about return definitions. So my favorite return is IRR. It's the internal rate of return, otherwise called the time value of money. IRR is unique because it factors in the timing and magnitude of all cash flows. And a dollar received sooner, is worth more than a dollar received later. I'm getting all kinds of notices that the webinar is not working. I don't know why people can't get in. Let me try sending them the link. Sorry about this. Give me 1 second. See if this helps them. I get 2 messages from people. See if they get in. So this is my favorite metric to measure because it really gives you an idea of your money. And if you think about my concept of compounding your money, you get your money early and you put your money back to work, then you can grow your money a lot quicker. Another one that is super important is an equity multiple. So it's the total cash return, including your principal, divided by the initial investment. So if you remember in my other example, I mentioned 2x. So 2x is 2 times your money. So if you put in $100,000, just like my example, our goal is to grow it to be, 100,000, grow it to 200,000. Cash on cash. Cash on cash is the annual pre-tax cash value flow received by an investor relative to the amount invested. Cash on cash helps compare different deals and weighs the benefits of cash distribution against long-term growth. But I'm going to go back real quick into my little thing here. So if you're going to try to live off the cash flow, because a lot of investors say, well, Trevor, I want to be able to live off my cash flow. And I understand that because I want to leave my job. So if you invest 100 and you earn 100 and you live off 100, first of all, you're not living very good. And so it's a very bit different, but at the end of 25 years, you're only going to have the 200 left. And then again, there's this preferred return. A preferred return is where we pay somebody in advance before it is working. So a preferred return means that our investors are going to get 7% before the sponsorship team earns. And then there's ARR, which is the average rate of return. And it takes all of the projected annual returns and it estimates their average value for an annual number. So again, what makes a huge difference in IRR, my favorite? The timing of cash flows. Earlier cash flow can result in a higher IRR, even with similar cash flow projects. A cash out refinance is not so popular right now, but it used to be popular, where cash out refinance significantly alters the cash flow pattern of a property, making it essential to recalculate the IRR using the new loan terms and cash out amounts and any tax complications on the property or increase in value. So the impact in the IRR can be positive or negative, depending on when the cash flow happens and the cash out timing. So this is a very simplistic view of all the IRR. So for example, if you invested $100,000, and this is kind of what we call the best case, and you're going to make about 40,000 in cash flow, then 50, then 60. All of these investments you're making, getting back 1.5 times your money. So again, that would give you a 21% IRR. Earlier cash flows, so you're going to get a little more money at the beginning, a little bit less as it goes along. That generates to a 25% cash flow. Lower cash flow at the beginning, so 20 year one, 50 and 80, results in an 18% IRR. And this one, there's no cash flow on the property, but you make your 50,000 on the exit. That works out to 14.5%. So again, some key differences. ARR is the annual profit. This considers the time value of money. It ignores the time value of money, considers the time value of money. This is simple and quick, but this is comprehensive. But I believe this really tells you what you're going to get. And again, it's more complex, requires a spreadsheet or calculator. So reasons why multifamily properties remain a good option, right? So you have steady cash flow. Multifamily properties provide a reliable source of income from multiple tenants. Even if one unit is vacant, income can come from other occupied units, and that help maintains cash flow, reducing the financial risk compared to a single family homes. In a strong rental market, filling vacancies can fill relatively quickly, minimizing downtime and maintaining a consistent cash flow. And again, long-term appreciation and wealth building. Properties go up in value over time. Multifamily real estate tends to appreciate in value over time, providing the potential for a significant long-term equity growth. And a strong rental market, properties improvements and overall market growth contribute to this appreciation. Easier financing. It sounds kind of crazy, but these bigger properties, they're actually easier to finance because they're financed based on the net operating income. And again, if you remember in my earlier statements, it says that the general partners will arrange this. So they'll have to have the net worth and the liquidity to be able to go ahead and be secured a loan along with the experience. So we can secure them, and you'll often be able to get a loan that can be super like non-recourse loans. And again, that's 70% loan to value factor. There are some huge tax advantages in real estate investing. You can benefit from various tax deductions related to maintenance, operational costs, management fees, and depreciation. And then we have this thing called cost segregation. So when you invest passively in a real estate syndication, the sponsor will order a cost segregation study to accelerate the depreciation. So instead of writing it off over 27 and a half or even 39 years, it breaks it into faster parts like appliances, floors, and even landscaping. And now they put on the big, beautiful bill back to 100% bonus depreciation. It can create a massive paper loss. So again, let's say you put $100,000 in, you'd roughly maybe get about a $50,000 passive loss in year one. Passive losses for real estate professionals go against our total income. For people with a W-2, it goes against their passive real estate income. So you have to be careful you understand how you get to use it. These will come through on your K1. And again, you can have some diversification, right? Multifamily housing helps you diversify your portfolio, spreading the risk across multiple units, reducing the reliance on a single tenant. They always need a place to live, making multifamily properties relatively recession resistance compared to other types of assets. Even during economic downturns, occupancy tends to trend and hold steady. So again, you get management of economies of scale, right? So we'll have a property manager on site for a larger property. They may even have a leasing manager that'll have some other staff. And some of our other units, for example, like we're closed, I'll show you here later, we have a 48 unit. We won't have on-site management, but we'll be using professional third-party management, and they'll be able to show up, but they manage other properties in the area, so they can show up for tours, they can show up for maintenance tickets. So again, we have somebody that takes care of everything for us, and then our asset manager on our team, they take care of everything. So none of our investors is going to hear about anything. So again, don't wait to buy real estate and wait. This is a really scary slide. So this is what's happened to rents. So you can see about 2020 rents and the cost of a mortgage were pretty close to each other. Look at this delta, almost $1,200 difference. So average rent is about $1,880. Average mortgage based on a median house price in America, 416, is over $3,000. Here's another scary statistic. This is a 10-year average of people that qualify for a mortgage. So in the past, about 48% of Americans qualified for a mortgage. Unfortunately now, 28% of people qualify for a mortgage. So that's really scary. 70% of America will not qualify to get a mortgage. So where does that mean they're going to be living? They're going to be living in an apartment. Here's another scary thing. In 2010, the first-time home buyer was an average of 30 years old. Now in 25, it's 40 years old. So either, again, you're living with mom and dad, or you're moving into an apartment complex. So again, you still have time. The next real estate cycle is among us. I'm going to go through these ones pretty quickly. Pricing is clearly reset. We've had several opportunities where the pricing has dropped between 15 and 25%. Now, I want to be honest, this has caused some distress for people that have invested in those properties. It makes it a little bit more challenging for them to make money. But again, real estate cycles create opportunities, and I believe this is one of the biggest opportunities. There's a large amount of loans coming mature. So there is like $936 billion in loans in maturity, and they're roughly going to peak out at $1.1 trillion in 29. What does this mean? It means they have to get out of the deal because it's going to be very challenging to be able to get new debt. And again, the bid ask and narrowing. So it used to be, property was for sale for $10 million. I use my example. We would make an offer for 9 and they would probably sell it for 9.9. Now we're getting our offers accepted at the 9. So it's a really big difference here. And then capital's not leaving real estate. It's just waiting for a little more discipline and the market to reset itself. And again, new supply is being choked off in key sectors. New real estate multifamily builds when interest rates were super low and everything was staggering. So check this out. 2021, there was 156,000 new multifamilies starting to be built. This number has now dropped to 37,000. And again, you can see over here, there was 1.1 million multifamily. It has dropped 53%. So what does this mean? This means that we're not getting a lot of new supply into the marketplace, and we're going to start to see rent growth again. And it's going to take a while for these numbers to start building back up, right? There'll be a little balancing act here in 26, and they'll start going up again. But I don't think they're ever going back. Because you look here, we had one peak here in 15. It's been pretty consistent. This is pretty consistent growth, and then boom, it just crashed off, right? So inflation has fallen, rates have lowered, so we hope that's good. And again, look at what the Fed did with rates, right? This was what caused a lot of the pressure, and they're starting to come down, and they're forecast that they're going to be down around in this area here by the end of this year. So again, there's a lot of distress at the operator level, not at the asset level. What does that mean? It means that the finances of the property are in trouble, but it's still a good property. The buyer field is thin. There's a lot of people that got out of the game. They got, there was a lot of blood in the streets, and a lot of people just did not make that market. It's still a little bit unfavorable, which is what you want as a real estate. You don't want to be buying when everybody else thinks it's the time to buy. You want to be buying when everybody else is cautious. And there's certainly signs that the cycle has quietly begun to grow up. So again, on our current investments, we're actually closed on this particular unit. We're going to be closing on Monday. This was an assisted living. So there's 16 beds here for assisted living, 16 beds for memory care. And again, this one here had a 7% return. It was about a 2.3x multiple of your money and a 20% IRR. This was a 506C offering. And again, this one here, we're fully funded. Stay tuned. We're going to be doing some more. A little bit about the opportunity I just want to share here. You can see when we did our underwriting, we've said, okay, because we're buying a facility that's empty. So we're saying that we're going to be making about $2.8 million because we're going to have about 1.4 million in vacancy. So we said we're going to be 50% vacant, 24% vacant, growing up to 5% vacant. And again, on assisted living, yes, there's a lot of money to be made. There's also a lot of money. So we're actually going to spend $750,000 in year one because we want to make sure we're staffing up, getting the good reviews, getting the referrals. And our staffing will end up at close to $1 million a year because, again, you want to make sure that you're offering awesome care. So here's a little bit about how the results are happening. So again, if you invested $100,000, there is no cash flow in the first year because we're ramping up a little bit in year 2, definitely more in year 3, year 4, and year 5. And then we're going to sell the property. So again, your $100,000 would grow to $237,000, which is that 2.38x multiple of your money. We have another opportunity in San Antonio, Texas. It's 48 units. It's also a 506C opportunity for accredited investors. It has about a 9% cash on cash, a 2x multiplier, and an 18% IRR. This particular one is a distressed unit. It was built in 1995, and the seller is self-managing it while he has a full-time job. So his occupancy is dipped down to 83%. We believe with professional management, we can move that up to 92% pretty quickly. We're going to go ahead and work on lifting it up. We're going to be very disciplined at the beginning. We are not looking for rent bumps. We're looking for occupancy, and then we're going to be able to grow the income as we go. For those that know San Antonio, here's where we are. Here's the Alamo. Here's downtown, 15 minutes away from the airport. Here's 10, 37, and 35. Very well located, very close to downtown, very close to a college here. And so again, average size units are about 707 square feet. They're mostly 2-bedroom units, and they have a lot of facilities. Here's again a little bit about the cash flow, right? So you'll make about 70. This is based on 100,000, 7,600, 82, 95, 90, and 10. So you'll make about $45,000 in cash flow. You'll make some money on the refinance, and your 100 becomes 206, which again gets you the 2x multiple. You can see again, these are some of the units on the inside that were staged for photos. Really nice units, look really good. So if you're interested in investing, reach out to me. 10 reasons why you should invest now. Real estate's on sale. We're at the bottom of the cycle. It starts our nearly 10-year low. Demand for multifamily housing has reached an all-time high. Buying homes is less affordable. We already talked about that. Competition, the lowest in a decade. Lower leverage than the 2022 deals. We have broken capital stacks. There's a lot of people that are having to get out because they're having to refinance. We're getting some buyer-friendly terms, the best in a decade. Tax advantages are at the best with the big, beautiful bill being passed. In the current markets, discuss what opportunities you see for investors, particularly in multifamily, as we navigate through this unique cycle. And again, you are one decision away from a new life. Massive dreams need massive action. There's my partners. And again, my goal is to help 100,000 people reach financial independence through real estate investing. I'm going to share, I'm sharing the link to join the Zoom here. I'm going to share my contact here. We had a lot of problems with folks being able to get on, so I'm super sorry to those that didn't get on. We'll make sure that this recording goes out tomorrow, and please reach out to me if you have any questions. So I am going to stop sharing. And did you have any questions, Ron? Is you got a solo presentation, my friend?
I do have a couple of questions.
Go
and
ahead, sir.
Thank you for the solo presentation.
Yeah, that's all right.
And you said there were other people that tried to join?
I've been getting some messages, and I sent the links out, and they're saying they can't get in. So I don't know how we
Really?
go.
Interesting. Okay. Yeah. I'll just say I'm 76 years old
Okay.
and just got into this. I was associated with what was it called? Lifestyles Unlimited.
Yeah, Lifestyles Unlimited before. Yes, great group.
Yep. And the 2008 time period is when our deals went pretty south. And so that kind of, I don't know what you want to call it. We didn't get all of our money back at that point in time like we had projected, which is fine. I understand. But that kind of soured my attitude toward real estate at that point. Just never got back into it.
Yeah.
Because, well, one thing that I never knew that Total Wealth Academy had started up, and they hadn't advertised on the radio hardly at all, and I just didn't know they were active.
Yeah.
So I got into it late, and maybe I should ask you, how late did you get into it?
So I started investing 7.5 years ago, so I was 58.
58. Okay.
Yeah. And again, I've had some winners and I've had a few losers, and the losers have been a bit lately. But I believe we're back into winner territory right now.
Okay, great. And my investments have probably, well, I know started last year, probably like around the first part of the year. And the Wildflower Springs is the third investment that I've got into right now.
All right.
Both of them, all three of them are, well, two multifamily and then the RAL investment
Yeah,
here.
well, we're excited to have you.
I appreciate that very much. And thank you very much again for accepting me off the wait list. That was
No,
very,
I'm glad you got in.
I am too, very, very much so. I was looking forward to this. And you say you're going to have some more uh, assisted living type.
We will later this year, yes.
Okay, later this year. Okay,
Yeah, we
great.
have some multifamily coming up and but we'll have some coming up soon in a while.
Okay, great. Well, uh, when you send this out, the it won't be just the video with no audio, correct?
No, it'll be audio as well. Yes, sir.
Okay, great. I would like to review this in detail.
Yeah, awesome. And then book a call with me. We can talk more.
Okay, fantastic. And let's see. Let me write your telephone number down, brother.
I can send you a
736.
quick email after this.
Okay, thank you very
Awesome.
much.
All right. Thanks for joining me. Have a great evening.
Okay, you too.
All
Thank you
right.
very
Thank
much.
you. Bye-bye.